Welcome back to the Deep Dive, the show where we take a stack of sources and really pull out the insights that matter, tailored just for you.
That's right.
Today, we're digging into the recent earnings call transcript from Pearl Global Industries Limited. They're a significant apparel manufacturer, big global footprint.
And our job here, our mission for this deep dive, is to sift through that transcript, cut through the usual earnings call noise, and really extract the key strategic points.
Exactly. We want to understand not just what happened in their last financial year,
but how they pulled off a record performance, especially with everything going on globally, and crucially, where they're positioning themselves next.
Right. So get ready. You'll see how some major global forces, manufacturing shifts, trade dynamics are playing out on the ground, all through the lens of this one company.
Okay, let's unpack it. So the results cover the quarter and the full year ending March 31st, 2025. They were presented by their managing director, Pallab Banerjee, and the group CFO, Sanjay Gandhi.
And the big headline, the main takeaway, is that FY25 was their best ever financial and operational performance. It's quite a statement.
It is. And what's interesting is they stress this isn't just a one-off. It builds on 16 straight quarters of growth since the pandemic really hit.
16 quarters. That kind of consistency, especially during such a turbulent time, really says something.
It does. And they were clear about why. They pointed directly to a relentless focus on operational efficiencies, really optimizing costs and pushing for productivity gains across their operations.
So it wasn't just riding a wave, it was internal effort driving it.
Exactly. Internal execution was the message.
Okay, let's get into the numbers then, the proof of that execution. Consolidated revenue, INR 4,506 crores for the full year. Just for context, 1 crore is 10 million rupees.
Right, and that revenue figure, it's up a solid 31.1% compared to the year before.
And the trend?
Well, over the last few years, that's a 31.9% compound annual growth rate, the CAGR. Pretty strong top-line growth.
And profitability, did that keep pace?
Even better, actually. Adjusted EBITDA, earnings before interest, taxes, depreciation, amortization. That core profitability measure hit INR 411 crores.
Which is up
29.8% year on year. But the GNBR, the growth trend over the past few years for EBITDA, is a staggering 61%.
Wow, 61% CAGR on EBITDA. That's some serious leverage.
Yeah.
And the bottom line, the profit after tax.
PAT, yeah. Also impressive. INR 248 crores, up 42% year on year. And the CAGR there is almost 95%.
95% TAGR on PAT. So growth, yes, but also much faster profit expansion.
Absolutely. And you see that reflected in their return ratios. They improved quite a bit. Return on capital employed, ROCE, jumped to 30.5%.
Yeah, for return on equity.
ROE climbed up to 20.1%. Those figures really show they're getting much better at using their capital to make money.
Operationally, you can see the scale too. Shipment volume.
Highest ever in FY25. They shipped 74 million pieces. That's a big jump from 57 million the year before. More volume feeds into that revenue growth.
Right. And what about dividends for investors?
They stuck to their policy. They aim to pay out at least 20% of consolidated PT each year. For FY25, the total payout was INR 52.8 crores.
Which works out to?
A 22.9% payout ratio, so just slightly above their minimum target.
Okay, so record results, strong growth, improving efficiency. But they achieve this against a backdrop of, well, chaos, right? The global landscape has been incredibly volatile.
That's where the strategy angle gets really interesting. The source material didn't shy away from the challenges. We're talking the last 3, maybe 4 years.
Yeah, what did they list? Inflationary pressures.
Shipping shortages, geopolitical conflicts, those wild inventory swings retailers had.
Supply chain disruptions just constantly.
Constantly. It's been a tough environment for anyone in manufacturing and trade.
And the latest wrinkle, these reciprocal tariffs imposed by the U.S. administration. That adds another layer for an exporter like them.
Precisely. And this is where they highlighted what they see as their key strength, their multi-geography presence, having factories in different countries.
That diversification, that flexibility, feels absolutely essential right now.
It seems to be their core strategic advantage.
Okay, so let's dive deeper into how these global dynamics and that multi-country strategy are actually playing out in their key markets, starting with the biggest, the United States.
Right. The U.S. is still their #1 market by revenue, but interestingly, they've been deliberately reducing their dependence on it.
How much?
Well, back in FY21, it was 86% of their top line. By FY25, it's down to 64%.
Okay, still significant, but a clear trend down.
Yes, and they made a really important point about that 64%. The actual amount of goods physically landing in the USA is lower. It's more like 46% to 50% of their total revenue.
How does that work?
Because a lot of their big US-based customers are global companies themselves. So they buy from Pearl Global, but then sell those clothes in markets outside the US too.
Ah, okay. That distinction matters, especially when you start talking about U.S. import tariffs.
Exactly. And on tariffs, the transcript went into the recent changes. There's a new baseline tariff, 10%, now active for imports from all countries into the U.S.
And China gets hit harder.
Yes. China has an additional 20% on top of that baseline. Sometimes people call it the fentanyl tariff. So for apparel from China, it's a total 30% tariff going into the U.S.
Ouch. Is that situation settled now?
Not entirely. They mentioned it's still dynamic. Trading partners are negotiating, looking for bilateral deals or free trade agreements, FTAs. It's evolving.
So with this uncertainty, plus maybe some consumer worries, how did that affect retailers? Did orders dry up?
Well, initially retailers were understandably a bit conservative, holding back maybe due to the tariff questions and general consumer mood. But the company reported that actual sales in April and May of 2025, so just after the period end, were tracking against their targets. Suggests things may be stabilized or retailers found ways to manage.
And how are retailers trying to manage that tariff impact? How does Pearl Global fit in?
Retailers are definitely looking to offset the costs. One tactic is asking vendors, like Pearl Global, to burden share.
Meaning absorb some of the tariff cost.
Exactly. Negotiating for the vendor to eat a percentage of the tariff hit. The transcript mentioned market negotiations were ranging anywhere from 1% to 4%.
And Pearl Global?
They said they agreed to absorb up to maybe 2%, 2.25% in some specific cases, not a blanket thing.
Okay, so some impact from burden sharing, but maybe limited.
Seems that way. And remember, since only about half their total revenue actually lands in the U.S., the overall financial hit from U.S. tariffs isn't, a massive feature for the company as a whole.
What else are retailers doing, besides asking vendors for discounts?
Well, the big one is shifting sourcing away from heavily tariffed countries, namely China, and that directly benefits manufacturers like Pearl Global who have factories elsewhere.
Right, that multi-country footprint again.
Exactly. Or retailers might ask for help with logistics costs, anything to lower that final landed price.
It really does sound like that diverse manufacturing base is paying off strategically. And didn't they get some recognition for that?
They did, yeah, a big one. They were named Vendor of the Year by a major U.S. retailer, one of their top 3 customers.
And why is that significant?
Because apparently that award usually goes to the huge, established global players, often companies based in South Korea or Taiwan. For a company from South Asia, from the Indian subcontinent, to get it is a real validation.
Shows they can execute complex stuff, multi-country, multi-product, for demanding clients.
Precisely, at a very high level.
Okay, that's a strong endorsement. Let's pivot to Europe, the European Union market. What's the story there?
The EU is obviously a huge consolidated market, and the big news here is potential. India is deep in negotiations for a free trade agreement, an FTA, with the EU.
An FTA being a deal to cut or eliminate tariffs and trade barriers.
Exactly. And those talks are expected to wrap up potentially within the next 2 quarters, so fairly soon.
Why is that FTA so crucial for Indian apparel makers?
Because right now, countries like Bangladesh, Cambodia, Turkey, Vietnam, they already have tariff advantages exporting into the EU. An India-EU FTA would basically level the playing field. Making
clothes sourced from India much more cost competitive.
Significantly more competitive. Pearl Global is already working with customers. They mentioned Inditex, based in Spain, is one of their top 3 strategic clients globally. They expect growth in the EU to really pick up once an FTA is signed.
Okay, now the UK. They just finalized an FTA with India, right?
Mm-hmm.
What does that mean practically?
Yeah, this is really positive news for their Indian manufacturing base. The India-UK FTA gets rid of duties which were up to 12% on Indian garments entering the UK.
So again, making India significantly more competitive.
That's the phrase they used. It puts India on par duty-wise with Bangladesh, Cambodia, Vietnam, Turkey, who already had duty-free access to the UK after Brexit.
And the timing is good too, isn't it? There's already a shift happening in UK sourcing.
There is. UK apparel imports from China have been falling quite dramatically. China's share dropped from about 35% in 2020 down to 21% by early 2025.
So India is well placed to grab some of that share, especially now with the FTA benefit.
Absolutely. Right now, the UK is about 5% of Pearl Global's total business, and most of that is currently served from their factories in Bangladesh.
But the forecast?
The forecast is specifically for UK revenue coming from their Indian factors to grow by a minimum of 3 times 3x within the next 2 years.
Wow.
Yeah. They have a dedicated office in London servicing those UK customers, ready to capture that growth.
Tripling business from one origin into a key market like the UK is huge. What about Australia and Japan?
Both markets where they're seeing steady growth, increasing their share. And importantly, India already has FTAs in place with both Australia and Japan.
I heard the Japan market is particularly demanding on quality.
That's right. Very high standards, almost 0 defects expected. Which is tough, but they see it as a positive. It forces them to up their game across all their manufacturing.
Improves processes everywhere.
Exactly. Plus, the market dynamics in Japan are different from the West, so it adds to their overall expertise. They're expecting significant continued growth in both Australia and Japan.
Okay, so if we pull it all together, market share breakdown at the end of FY25. Remind us.
Right. For the top line reported, U.S. was 64%, but remember, maybe only 46-50% actually lands there. European Union around 16%, Japan about 7%. Australia and the U.K. were roughly 5% each, and Canada was around 3%.
So you can really see that diversification strategy in action, reducing reliance on just the U.S.
Definitely. It's a much more balanced picture than a few years ago.
Let's shift focus now to the engine room, their manufacturing bases. Truly multi-country, India, Bangladesh, Vietnam, Indonesia, and Guatemala. Let's start with India.
India really picked up its performance in FY25. Standalone revenue from their India operations hit INR 11,196 crores. That's up 25.4% year-on-year.
And profitability there.
That was a big turnaround story. They got the India EBITDA margin up to 10.2% in the fourth quarter, Q4 FY25. Reaching double-digit margins in India is significant for them.
Have they been adding capacity in India too?
Yes. They have their established bases in Gurgaon, Bangalore, Chennai, and they've added more multi-product capabilities there. They've built out capacity specifically aiming to handle over INR 1,600 crores of business from India.
Getting ready for those FTA opportunities like the UK one.
Exactly, preparing to accelerate. And they're also expanding into Tier 2 cities. They mentioned a factory in Bihar is up and running, scaling now. Plus, they've secured more capacity via partnerships in Orissa and Andhra Pradesh.
Okay, how about Bangladesh? It's such a powerhouse in global apparel.
Bangladesh has been a rock for them. Consistently strong results over the last year, even navigating some government transition and unrest smoothly.
Performance-wise.
Highest ever shipment volumes from Bangladesh came in Q4 with 0 delays reported. So very robust operations, healthy order book growing. Their factories there are running pretty much flat out at optimal capacity, and they're increasing work with partnership factories too.
What makes Bangladesh so advantageous for them, the core strengths?
It's a combination of things. Competitive costs, definitely.
Yeah.
High productivity levels, a large skilled labor pool, experienced local management, and critically, those favorable trade agreements.
Right. Duty-free access to the EU, UK, Canada, Australia, China.
Exactly. And they also mentioned Bangladesh has even started initial talks about a potential FTA with the U.S. That would be huge if it happens.
Now, there was something mentioned on the call about a restriction on yarn imports from India into Bangladesh via road. Did that cause problems?
Management addressed that directly. They said, nope, that specific ruling did not impact their operations at all. Their supply chains in Bangladesh weren't reliant on that particular route from India. No impact seen.
And are they expanding in Bangladesh?
Actively, they're looking at capacity expansion, maybe even acquisitions. They've already bought land there that could eventually house an extra 2,500 to 3,000 sewing machines. So big future growth potential plan for Bangladesh.
Okay, let's head east to Vietnam.
Vietnam, they're very bullish on Vietnam. It's another country actively talking to the U.S. about a potential FTA or some kind of bilateral trade deal.
And Vietnam's already part of that big Pacific Trade Pact.
Yes. Crucially, Vietnam joined the CPTPP, the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, in December 2024. That gives them 0 tariff access to a bunch of countries, including Canada and the UK.
So Vietnam already has great access to key markets. How's business there?
Strong growth from Vietnam in Q4. They landed a new client, a fast-growing premium retailer from Canada that's also expanding in the U.S. So Vietnam's positioning is really helping them win that kind of business. They've also set up a new partnership factory there.
The outlook.
They expect meaningful growth from Vietnam over the next year, The focus is steady expansion, high-quality service for that premium client base. Revenue-wise, they said Vietnam is nearing $100 million and should comfortably cross that mark.
What about Indonesia?
Indonesia is ramping up. Their new factory there is now fully operational. They're seeing strong customer interest.
So the plan is
Scale up production significantly over the next few quarters. They expect Indonesia to contribute much more in terms of volume and value in this current financial year. They're focusing on premium clients there too. Potential revenue, they think, can easily cross $30 million, maybe even hit $35 million or more in the next couple of years.
Okay, and the final manufacturing base, the one in Central America, Guatemala.
Guatemala's main draw is location, location, location. It offers much faster shipping times to the U.S. market, just over a week by sea. Plus, it has zero WTO tariff status for certain goods going into the U.S.
Meaning no basic import duties under WTO rules.
Correct. However, the scale of their operation there is still pretty small compared to Asia.
And they hit some speed bumps initially.
They did. They expanded fast, went from 3 lines to 12 lines, which caused some short-term operational headaches, staffing, training new people, that sort of thing.
How are they addressing that?
They brought in a new CEO for Guatemala focused on efficiency. Productivity has already improved, up from the mid-40s percentage-wise, aiming for 70–75%. Importantly, they kept customers happy through reliable service despite the internal challenges, so they kept the business.
What's the outlook now?
They're confident they can turn it around strongly and hit cash break-even in Guatemala within this coming year. Revenue potential. Max maybe $10 million to $15 million. They did acknowledge it's a more expensive place to operate, less efficient than Asia.
So why be there?
Partly to showcase capability, to show customers they can offer nearshoring options, speed to the U.S. market, even if it's not their main volume driver.
It really sounds like this whole multi-country setup isn't just about hedging bets.
Yeah.
It's about actively positioning to grab opportunities from trade deals, tariffs, logistics, needs.
That sums it up perfectly. And their customer strategy flows directly from that. They're constantly adding new clients, helped by this reputation they've built as a reliable global supplier who can handle complexity across countries and products.
Is it easy to win new clients in this industry?
No, the source noted the entry barriers are high. It's tough to acquire major new customers. But they seem to have navigated that well, bringing on some significant new business recently.
How long does that acquisition process take, typically?
It varies. Could be several months, could be over a year. It really depends on understanding what the potential customer needs strategically, where their gaps are, their white space, and showing how Pearl Global can fill it.
And having that multi-country offer helps.
Big advantage. It might shorten the lead time or just give them the capability needed to win the deal in the first place. They mentioned landing at least 2 big new clients last year, each with potential for $20–30 million plus annually.
How concentrated is their business? Do a few big clients dominate?
It's somewhat concentrated, yeah, which isn't unusual in apparel. Their top 5 clients make up about 60% of revenue. Top 10 is around 78–80%.
But their share of each client's total business varies.
Hugely. That wallet share depends on the client size. So for a big U.S. retailer like Kohl's, one of their top 3, Pearl Global might only have a single-digit share, maybe 5–7% of Kohl's total apparel sourcing.
Because Kohl's is massive and uses many suppliers.
Exactly. And for a truly global giant like Inditex, also top 3 for them, their share might be tiny, less than 1% or 2%, just because Inditex's scale is enormous.
What's their goal for client size?
They want to build relationships where their top 3 or 4 clients are doing around $100 million in business with them annually, and the next tier of clients in the $50 million range.
They also have a significant in-house design team, right? About 75 people. How does that fit in?
Yeah, the design team is a key part of their proactive approach. They aren't just waiting for orders. They're constantly designing and showing new products based on their manufacturing strengths and what's trending.
And having designers in key markets helps.
Definitely. Teams in showrooms in the US, UK, Spain let them work really closely with customer design teams, co-create, understand needs deeply. It's effective too. About 40–50% of the products they actually make originate from their own design concepts.
Helps fill the factories proactively.
Exactly.
Okay, let's shift to the financials, governance, and their investment plans, CapEx. Financially, they look pretty solid.
Very solid. Their net debt to EBITDA ratio, that key leverage metric, has improved dramatically. It went from 3.43x back in March 2021 down to negative 0.04x as of March 2025.
Negative, meaning more cash than debt relative to earnings.
Precisely. That's a very strong position. They also had a healthy cash and bank balance INR 513 crores as of March 31st, 2025, excluding money tied up in letters of credit. And their working capital management looks efficient too. Net working capital days down at 38.
Below target. Was this strength recognized externally?
Yes. ICRA, the credit rating agency, gave them an A stable rating for long-term debt and A1 for short-term. Reflects that strong financial position and ability to meet obligations.
And governance. Any changes?
They beefed up governance too. Added 2 new independent directors to their board, appointed Deloitte as statutory auditor for their Hong Kong subsidiary, and expanded Ernst & Young's internal audit scope to cover Vietnam now, as well as India and Bangladesh. So strengthening oversight.
Right. Let's talk CapEx capital expenditure. What did they invest in last year, FY25?
Total CapEx in FY25 was INR 135 crores. The breakdown was about INR 75 crores for actual capacity expansion and building a sustainable laundry in Bangladesh. Another INR 22.5 crores went to buying land in Bangladesh for future expansion.
That land purchase sounds significant.
It is. They said it could potentially add 2,500 to 3,000 machines down the line. They also spent INR 12.5 crores on a partnership capacity project in Vietnam. The rest was routine stuff, replacement machinery, efficiency upgrades. Oh, and they also secured leasehold land in Madhya Pradesh, India, potentially for another 1,500 machines.
Okay, what about the plan for this year, FY26?
Bigger plans for FY26. Total planned CapEx is INR 250 crores.
Where's that going?
INR 30 crores is earmarked specifically for capacity expansion, mostly in Bangladesh, INR 100 CR, but also some in India, INR 20 CR. Then there's INR 90 crores for more sustainable laundry capacity, again in Bangladesh.
Laundry seems a big focus there.
It does, plus INR 5 crores for solar power at their Indian factories, and the rest for ongoing replacement and efficiency.
How much new production capacity in terms of garments will that FY26 CapEx add?
They estimate it will add about 8 million pieces of annual capacity, roughly 5 to 6 million of that in Bangladesh, and 2.5 to 3.5 million in India.
Let's circle back to that laundry investment in Bangladesh. Why the big focus? What are the benefits?
Multiple benefits, strategically and financially. Doing more washing and finishing in-house significantly cuts their costs compared to outsourcing it.
Okay, cost saving. What else?
Sustainability. The new laundries use advanced tech that drastically cuts water consumption. Big environmental plus. And financially, they expect a strong return on that investment, projecting 18-20% ROCE.
So lower cost, better sustainability, good financial return. Makes sense.
Yeah, and they stress that sustainability is baked into all their CapEx projects now. Optimizing water, energy, minimizing environmental impact is standard practice.
Okay, let's talk capacity versus output. Current installed capacity is around 93 million pieces. They shipped 74 million last year. Adding 8 million brings them over 101 million capacity by end of FY26. But their medium-term goal is much higher.
Right. By early FY28, so in about 2 years, they're aiming for around 130 million pieces of capacity.
That's a big jump from where they are now. Why build so far ahead?
It seems intentional. They want the capacity ready before the orders fully materialize so they can capture growth quickly as customers shift sourcing or as these new FTAs kick in. That 130 million capacity target is designed so they can comfortably ship 100 million pieces in that FY28 timeframe.
What's their current utilization rate?
Across the group, it was around 77% overall in FY25. But varies. India, for instance, was running over 90% utilization in Q4. They're clearly building ahead of current demand. Their target for volume growth, CAGR, is 14% plus going forward, which aligns with needing that bigger capacity base.
Okay, finally, profitability targets. India hit double-digit EBITDA margins in Q4. Overall group-adjusted EBITDA looks strong too. What's the medium-term goal for margins?
They're confident they can get to and stay in double-digit EBITDA margins for the consolidated group. The target range they mention is 10% to 12%.
And how do they plan to get there, besides just more volume?
They listed several levers. Guatemala turning profitable as efficiency improves, Indonesia reaching full utilization and scale, India continuing its strong margin performance as capacity ramps up, plus ongoing efficiency drives across the company and those cost savings from the sustainability capex, like the laundries.
So clear pathways identified to hit that 10-12% range.
Yeah, they seem to feel the potential's been demonstrated and the operational levers are now in place across the different sites to achieve it.
So there you have it. We've taken our deep dive into Pearl Global's recent earnings transcript. And the picture that emerges, well, it's a company achieving really remarkable record results in FY25.
Yeah, through disciplined operational focus, even while navigating some serious Global turbulence, inflation, supply chains, tariffs.
And that multi-geography manufacturing footprint, it's clearly more than just history. It's a core strategic asset now, gives them resilience, positions them really well as global trade gets reshaped by FTAs and sourcing shifts.
They're actively putting money into expanding capacity, especially in India and Bangladesh, and doing it with an eye on sustainability while also tightening up profitability and governance.
It's a pretty compelling case study, isn't it? How a global manufacturer adapts, even thrives, in this complex, fast-changing international scene.
Absolutely.
So here's something for you to think about after this discussion. We see global trade patterns being actively reshaped: geopolitics, tariffs, these new trade agreements. How do you think the big apparel brands and retailers will continue to adjust where and how they get their products made?
It's a constant calculation for them.
Right. And what does that mean? Not just for the profits of companies like Global, but for the actual economies, the infrastructure, the workers, in all these different regions where manufacturers choose to operate and invest.
Yeah, lots of layers to that question.
Yeah.
Worth considering.
Indeed. And that wraps up this deep dive.